The strategies and concepts discussed are for educational purposes only and do not represent specific investment, tax, or estate planning advice. Investing carries an inherent element of risk, and it is possible to lose principal and interest when investing in securities. No strategy can guarantee a profit or prevent against a loss. The views expressed represent the personal opinions of the presenter or the featured guests, not necessarily those of USA Financial or its affiliated subsidiaries. Any opinions or forecasting statements are subject to change at any time and without notice. John Cindia is an investment advisor representative of, and advisory services are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. Life Stages Advisory, Dean, and Remington are not affiliated with USA Financial Securities. Welcome to episode 52 of WTF Wealth, Tax, and Finances. I'm your host, John Cindia, certified public accountant and personal financial specialist. I have Rem and Dean in the studio today. Hi, guys.
Hello.
Hey, how you doing?
You talking to me?
You like this show?
Yeah. Anyway, I hope that's in the cut. I don't know. Is that the cut version?
No, it might be in there. I don't know.
Today, what I thought we would talk about, markets up, okay? Everything's up. Cryptocurrency's up. The markets are up. Stocks are up. Everything's up. We've already gotten a partial COVID payout. They're looking to have more money coming out from the government, and people are still laid off. So it's a have and have not situation, I guess. So what I wanted to do here is look at your investments and what you currently have. There was a reason you got into the market, and I don't know if you figured you have a big ego and you thought you could do better than the market, you could do as well as the market. Did you have a plan going in? Were you looking for it for massive gains because of the way some of these stocks have gone up? It's crazy. So you really have to have a plan when you get in to the stock market or any other type of investment. And what I wanted to do was address and consider a couple of items. It's probably more going to be thought-provoking than facts that you should have either done at the outset when you were making your investment plan, almost like a policy. And because when we help clients, we have what we call an investment policy, investment statement. And the reason for all the questions is, what do you want to do with this money? Is it long-term? Is it short-term? Is it intermediate term? Are we looking to put it in for supplemental savings? Are we looking to live off of it upon retirement? Do we want to retire early? So everything that we're doing has a different and specific duty to it.
That's fine.
That's fine. Okay, good.
That word makes me laugh.
Yes, I know it does. Have to deal with these kids in here.
We're professionals.
Yes, okay. So everything has its own action plan, and I just want to avoid its own duty. I guess its own service. It has a function, okay? And just like when we were talking about starting to save up for your emergency fund, it doesn't necessarily have to earn anything. It has to be there for you for an emergency. So if you need to go down and get $1,000, you need it today or this afternoon, go down to the bank and get it, okay? You don't have to sell something. You don't have to wait so many days for it to clear out before you can get your money. So that's what we're looking at, okay? So everything has a specific duty to it. And what we want to do is back up a little bit and say, okay, now that we've gotten gains from last year, it's hard to say. Depending on the type and risk that you've taken on, you could have earned 20, 30, 40%. Some of these stocks and things have gone up hundreds of percent. But the market on a whole, when it hit the high of February of 12th last year, and it bottomed just about 38 to 40% down on March 23rd. And by March 26th, if you'd have gotten out, you'd have missed a 15% rebound on that. So it's one of these things of saying, okay, I don't want to be I don't want to be emotionally involved to get in and out every time the market has a huge drop, because it's always a delay of whenever you get in. Very important to have a plan, know when you should get out, when you shouldn't get out. We're not trying to talk about timing the market. We want to do something that's not emotional, okay? So what I want to do is make sure that if you haven't had a plan, let's start thinking about an exit plan, okay? You're in the market, so you didn't really have a plan going in, but you're there. So now, what should you do at the top of the market? I'm not saying everybody should panic and sell out, because we're at the top. We've already hit a couple of tops in the last year, and it just keeps going higher. But at some point, after this 11, we're almost into the 12th year of this bull market. We had a correction last March, like I talked about, but there's going to be a more intense pullback at some point, and it could last a lot longer than it did. Okay, so people talk about rotations. A lot of everything that's been in, and a lot of the market has gone on just a growth tear. So everything is growth. Nobody's worried about income. Nobody's worried about value, getting something that might have been beat up during the COVID crisis here. Restaurants, airlines, hospitality took a big hit last year, and hopefully they'll be rebounding this year. So those would be something that I would consider like more of a value play. And we might be looking at rotating out of some of the growth and going into value, maybe going into some emerging markets, expanding a little bit out of the U.S. from just pure large cap, mid cap, or small cap growth plays. So we want to be a lot more diversified. So I guess what I'm looking at is saying, okay, if you don't have a plan, go back and develop one now. And you almost have to start at the end to go back to the beginning. In other words, you're already at the top of a market. Is there some of your holdings that you should start paring back? Now, I'm not telling selling out of everything, but once this stimulus has happened and more money is coming out, there's already about $4.5 to $5 trillion that has been spent during COVID here in the last year. They're looking at probably another 2 to 3 trillion. So by the time we're done, it could be $7 to $10 trillion. That is almost a 30 to 35% increase of the debt that we had prior to the COVID shutdown, lockdown, and pandemic here. So with a flood of money, it is propelling the market to maintain itself and keep going up, trying to stimulate the economy. And it's in certain areas. So I guess what I'm looking at is saying, let's start becoming a little more aware of the market, of its tops, and what happens when we have, which is pretty much looking like a bubble coming in. So rather than ride that down and lose 50, 60, 70% and then get out, let's start taking some profits. So there again, this goes into your plan. What does that mean? I've already had some stocks that are up 50, 60, 100% just in the last 6 months. So if that's the case, I'll probably be taking either a percentage of those off the table, or at least getting my initial investment back out and then letting the rest of that ride. There again, it depends on which stocks I'm looking at. So it's not an one plan fits all stocks, but certain, just like, you have a different reason for investing either long or short term, then you have a different reason for either hanging on to a stock, either longer term, intermediate term, or short term. So if you're looking at speculation, which a lot of people do, then it's a very short term situation. And if you're looking to put a percentage, and hey, I made 200% in 3 months, and as soon as I did that, I wanted to sell. I would think that most people out there don't have that type of a plan set up. So how do you get out of the market? There's different ways. There's different risk management styles that you can do. And what I wanted to do is just touch on a few of them. You need to go and look these up and study them and look and see which ones, if any, would pertain to you or sound like something that you'd be interested in or would like to try. You've probably heard of stop losses before, and basically what that is, if I had a stock that was at 50 when I bought it and it went up to 100, you've doubled your money. You could turn around and take your original investment out, like I talked about just a few minutes ago. You could turn around and say, hey, I want to take 20 or 30% off the table. Maybe I take half of it off and let the rest of it run. You could back out, almost do a reverse dollar cost average. If you dollar costed in on the stock over several months and you had $1,000 a month for 5 months, well, maybe you can turn around and take 20% out over 5 months and see how the market goes. Just different things to look at from that standpoint. A stop loss would turn around and say, okay, I purchased it at 50, it's up to 100, and I want to put maybe a 25% stop loss on. Well, that means then if the market went down to 75 or the stock went down to 75, it's going to trigger. And the thing about these is you don't have to stand there and watch these constantly. You might be traveling and all of a sudden the market goes down, the stock goes down $25 that day. You happen to be not looking at it and wanted to sell it, but it went all the way down to 40, say. Well, you lost your opportunity to get out because you were traveling or not paying attention to the market that day. So if you put a stop loss in at 75, basically it'll trigger and it'll go to a market sell at that point. So as soon as it's down to 75, it may get out at, say, 74. It could go down to 70. Don't know what it would be. But it would at least trigger that, and you would be able to capture some of your gains anyway. There's another thing called a trailing stop. And what happens is I like a trailing stop, but then you may look at it a little bit differently. Say you had that $50 stock again and it went up to 100 and you had a 25% stop loss on there. Well, all of a sudden that stock went up to 150. Well, if you had that stop loss on it, that you're going to lose basically 50% of that before it triggers. So now all of a sudden that stop loss is still at 75, but you got 150. Well, that means that stock's going to have to drop 50% down to 75, and then it gets triggered. So with a trailing stop, what would happen is I put on a 25% trailing stop. It's at 100. It goes up to 150. Okay, now the market adjusts. As soon as it hits a 25%, it would be right around $112.50. Then it would trigger and it would sell then. So as my stock goes up, that 25% is in a ratio based on that increasing. So I like that a lot because it follows the stock up, and it sort of helps to guarantee that you don't get out way too early. Because I've had stock situations that I got out and the thing just took off and ran, and you're just frustrated with something like that.
So I've heard of the stop loss, but never the trailing stop.
Mm-hmm.
Would certain brokerages, depending on, I don't want to get into specifics by any means, but would there be certain brokerages that would not offer something like that?
Oh, yeah. Yeah, a lot of them don't. I mean, some of that gets into the sophistication of it. It's either they probably offer it, but they're going to do it at a different level, and you'll probably have to pay something for it.
Pay or call them or something along that
More
lines.
than likely, you're probably looking at, like you get into like these discount brokers, and they'll give you a lot of capabilities, free. So if you want like an advanced trading platform, you want to do something different, it might cost you $25 or $50 a month.
Yeah, that's what I figured.
Yeah, you'd have to do something from that standpoint. Now they would turn around and do something like that. Also, if you wanted to trade options and you were big into options, or you wanted futures or something else, or you wanted to leverage your money, and run something like that.
You're going to have to pay a premium monthly price for that.
You'd be looking at a premium type service or whatever. So, but a lot of them won't do anything very complex. For
it's
free.
Usually pretty simple. Yeah, that's what I've seen from the two that I've used. It's just the basic market orders and then stop losses. And I think there's one other one. I can't remember.
You can do limit orders.
Limit orders.
Yeah.
So that's the one. Is that the one that it won't buy until it's a certain price?
Right. You can either you can put a limit on a sell or a buy, and it's like, hey, the stock is at 50. I'll buy it at 40. Well, I can put a limit order, a buy order at 40. I'm sorry, if it's at 50, I want to wait till it pulls back to 40. On the other hand, I don't want to sell it till it hits 60. So, you can have stuff like that.
You can run
on
it
there.
both ways.
You can run it either way,
right?
Whether you sell it or you buy it. And the thing is that when you put the limit orders in, sometimes I've had stocks that dropped through, and say it went from it was a $60 stock and I had a $55 limit on it. It blows right through that. It might not get triggered to 40 because maybe it just had a big drop on it, or nobody was bidding on it because it was going down so fast.
Right.
So you might not get it 55. It could be 40.
Yeah. So that
or it doesn't trigger at all.
It can't be guaranteed that that's going to go through.
Exactly. So you have to look at those, and I don't get very sophisticated with a lot of that stuff because I have, I'm watching it and I want to get in and out. I'm not going to be a pig about it. And that's what the problem is. It's like the old statement, pigs get fed and hogs get slaughtered and stuff like that. So I don't mind being a pig, trying to stay in there for a while and get a gain. But when you're going to be a hog about it and going, I'm just going to stay in here and get it and all this other stuff, something's going to turn on you.
Right.
And it's like, I don't need to squeeze every penny out of that. If the thing was potentially 120% gain and I got 80, I'm happy. If
it's better than zero.
Exactly.
Or negative.
And there again, it's the risk management situation. You go into something, everybody wants to make money. You're not looking at it from a standpoint of going, well, I wasn't planning on losing, 50%. Well, see, that's the whole thing about the risk management, the type of investments and the plan that I'm talking about. You really have to have, everybody's got an entry plan, or, well, I'm just going to buy some,
right.
Whatever. And then, but they don't think about how to get out. So,
or what their end goal is.
Yeah.
Really.
You were saying something earlier off mic here that you had put $500 in and then you got out, but you didn't know why. So this would be a good thing to sit there and discuss.
Yeah. So last, I actually bought about $200 in at like the ultimate low.
Mm-hmm.
It was middle of March, sort of late end of March. Right. I kind of diversified. I bought into like a couple entertainment leisure stocks, like cruise lines and stuff like that. Mm-hmm. I think I bought a little bit into the airlines, and then I bought I'm trying to remember what the other one was that I bought, but it was like 4 or 5 different stocks that I bought into, and kind of just wrote them out, and I kept putting $50 in, $50 in every time I got paid, and I got up to about $500 that I had invested, and I didn't know what my end goal was, and I kind of started putting my money into one singular stock, not being specific, that was kind of just riding, and it was making like year to date, it was like up like 4% or something. It was like it wasn't going down, it wasn't going up, so it was pretty straightforward. And I was like, all right, what am I doing? Am I going to just continue putting all of my money into this one singular stock, or am I going to diversify, or what am I trying to do? And eventually I was like, looking at everything, I looked at what I had invested, and I was like, I'm up $250. I'm just going to pull it all out and spend it.
Yeah.
And I mean, that was like my first time like investing. I'd never invested before. So I think part of what I wanted was like a little entry trial of like kind of just see how the market plays, kind of pay attention to it a little more than I normally would, things like that. So it was kind of fun. And I mean, like it's definitely exciting when you're making money.
Oh, sure.
But if you're losing money, it's probably not so exciting. And I mean, there was a couple, some of the cruise lines I bought into, they lost money. So
sure.
COVID
hit. Yeah. Everything's going out.
It's kind of the game you play with it. But I mean, like, definitely for the first time investing, I would for me, or maybe if you've never even done it before, maybe a little trial run like that
Sure.
is good for you. And not like, and I know like I have some buddies who they want to invest like a lot of money really fast and pull it out. They want to do day trading.
Oh, sure.
And I can't agree with that.
Well, it's total speculation, and that's what I see a lot of this stuff. If you look at the cryptocurrencies, when you get into them and they start looking at it, you look at the hold days, and long term to somebody is 45 days. I've
Not
looked
several
at Bitcoin
years.
and no, they're looking at it, and some of them are going, oh, well, it's average hold time 5 days. Well, it's just nuts. I mean, why are you into it? The stuff that I've got is up, but I've looked at this. Like I said before, I finally got into some cryptocurrencies, and I've sort of legged in. I got a little bit of money here and there, and then I've got a few $1,000s into it. But I could see $3,000 go down to $2,000
In a day.
in 24 hours.
Oh yeah, in a day.
And all of a sudden, it's back up $1,500. Within 48 hours.
You don't never know when to pull out.
That, it's so volatile, you can't. You're either going to be in there to stick and see the trend go and stay with it.
Right.
You can't. I don't see how you could possibly day trade that. I mean, you couldn't even trade it by the minute. I mean, it drives you crazy.
It's changing by tens of dollars by the second.
Oh, yeah.
If you just get in there and you look at it live, it's the way that those coins move. Even the lower priced ones, several pennies, like every single second. I'm like, I don't even know how people keep up with this.
Yeah. You have to look at it. I looked at the stuff that was investing in that had at least $1 billion in valuation. If it didn't have $1 billion, I really wasn't interested in it. So that leaves you out pretty much into the top 10 or so that are going to be there.
The higher price, crypto is probably over $200 or $300.
Not necessarily. No, there's still
some
a lot
of them are pretty cheap ones.
Oh yeah,
Really?
I had some of these that had a $1 billion valuation that only a dime a piece or so. So I've got some of them that have 3,000-4,000 shares.
That's
of
pretty
this
good
stuff. Yeah. So it just sort of you have to go into it and look at it, and that's why I thought if I wasn't going to do something with it, then I was going to be ignorant. I didn't want to, because I still have clients. What do you think about crypto? It's like, well, to me, it's like anything else. Whatever your investments are, if you've got, say, 100% of it, you usually limit it to precious metals and gold and silver and platinum, things like that, maybe 2 to 3%, 5% at the max. I would say cryptocurrency is probably in there. But, you got some of these crazy people that want to go all in. Well, yeah, it looks impressive, but, if you don't have the guts for it,
or you have that thing off the side of your peripheral vision all day long, watching to see if it's going to drop.
You can't do it. I mean, I look at it a couple times a day just to see what it is, but I've seen this stuff, like I said, it's nothing for it to go, you've got $4,000 into it, 25 to 30%, it'll move, within that 24-hour period down, and it'll go back up 40.
Yeah.
And so it's very, very volatile. But the trend is still up, and there's where the trend is. And with this cash coming off the sidelines of people not having gone into it and staying on the sidelines all this last year, cash is going in. And I saw a report the other day that it's not coming out of savings, it's actually cash. So it's this sideline stuff. And that's what people use as buying things. It's not being used for saving, it's for buying. So that's going to affect the economy. And that's going to keep things propped up for a while.
Right.
So even though there's portions of the economy that aren't doing well, this hoard of cash that's sitting on the sidelines and stuff is going to keep things moving up. So you don't want to miss that ride, but you still want to make sure that you have some type of risk control in that. And that's why I'm saying sort of going back and putting in a plan if you didn't have one. And I'm sure most people don't. They just get in. I got to be in the market, so because everybody else is.
Yeah, time to buy.
And I don't know, and then they sit there and go, well, should I get out? I've had clients that, they're in a panic every time. I had some call the other day, and they're in a panic because they heard something. What'd you hear? Well, it's like, No, that's not a good reason.
Yeah. Turn off the white noise.
Is that why we got into the market? Well, no, that's not it. Then has anything changed? No. Are you older? Do you need the money next week? Or, what's going on? No. Then our plan's intact. So,
It's staying the same.
If nothing major has changed in your life or your plan, you haven't lost a job, you haven't gotten a divorce, you haven't gotten married, you haven't had kids, nothing else is going to, and from that standpoint, or you've got a big move, you won the lottery, whatever. If nothing's changed, then our plan hasn't changed. And just because you make a plan at some point in time doesn't mean that it's not dynamic. It just doesn't just sit there and it's the same plan. You look in the rearview mirror and 20 years later, well, we never really tweaked that. We should have. No, you said it. It could change in 6 months. It could maybe not change. We keep looking at it. It might not change for 2 years. But what you end up having is a plan. And if nothing drastic changes, you just stay to the plan. You might add more money into it. You might take a little bit out of it. You might diversify differently or whatever. But here's the plan, and that's what we maintain. So I think, if you look at it from that aspect, you're incorporating some risk management on this. You're trying to take a little bit off the table, do some rotation, start looking at some value plays, maybe take a little bit of growth off of there. But I'm not saying go to cash. I'm not saying anything like that. What I'm saying is look at it, scrutinize it a little bit, and actually ask yourself, why am I in here? What do I want these stocks, bonds, ETFs, mutual funds, what do I want them to do? What are they supposed to accomplish for me? Long-term, short-term, intermediate, whatever. And just get that in and complete your process of that investment plan that you have. Rem, you have anything to add about what you were talking about earlier?
What we were talking about earlier for me is I'm not in on any of this.
Okay.
I would like to be. I got a little overwhelmed from the start because I think I started way too big.
Okay.
I was like, I'm just going to start going after crazy stocks and realized I can't do that.
Yeah.
So I might need to just take some time and start on one of the little apps that we've mentioned previously and just
Sure.
figure it out from there. Just start small. Don't get in over my head.
And that's the thing, commit something that, if you can, you have to go into it looking at it, how much can I lose? If you say, oh, well, I don't want to lose anything, well, you're going to have to talk to yourself in the mirror, I guess, and say, where do I want to be?
Is this really for me?
Yes.
I could definitely stand to play around and maybe lose a little bit, but I think, like I was saying, I started off way too big expecting to go in and make crazy money, and then I realized I have no idea what I'm doing.
Yeah.
So,
That's why for me it was like $50 to pay.
Yeah.
Obviously I wasn't willing to lose 50 to 0.
Right.
But if I lost 20 or 30%, I learned my lesson.
Yeah.
You know what I mean?
And I think it's the same thing. You have to, whether it's $500 or whatever, look at it there again, back when we were talking about putting our budgets in, and from the expense side, if you were cutting back a latte a week or a couple or whatever, take that out of what you were doing, and it's not changing your lifestyle, okay? And maybe use that money and just transfer it. What I like to look at, I wanted to develop an app at one point, but it was just going to take too much time, and it was sort of play around with it. But if I spent $5, I'm saving $5, okay? If I had, I wanted to buy my $5 latte, I put $5 aside. If I had a $25 game, I put $25 to savings.
There's actually a app that does that.
Does it?
It's we're not sponsored in any way, but it's called Capital with a Q.
Okay.
And you can do a bunch of cool things like that, where it's like if you can set it to match, you can set it to do a percentage.
Mhm.
So if, like you said, if I spend $20, it'll put $20 in, or maybe for every $10 it saves $2.
Okay. And that's what, it would be a situation.
I'd be broke on payday.
Well, here's the thing.
It'd be like
if you look-
$400 car loan. It's $400 saving.
Well, here's the thing. I'm just looking at it from a standpoint of whatever you'd have from your discretionary income.
Right.
You know, so if you had $500 and you go, geez, you know, I don't have anything left at the end of the month, but you know that you should have had $500 literally by the middle of that month. If you were spending an equivalent amount by the middle of the month, you would have spent $250, but you should have $250 in savings theoretically. Yeah. And then you can at least look at it and go, oh my God. But you know, you've got a rolling amount that you're looking at and saying, wait a minute here. So it's that, you know, you don't have a huge delayed need gratification, or, you know, it's like, it's happening now. I spend that, look at that. Oh my God, you know.
Yeah. And you don't, I think the another big thing is you don't have to move the money. If the app does it for you, you know, it's literally automatic. You don't even know it's coming out.
It just gets out of your hand. And
Goodbye.
Head over there. And that's the thing, you know, you have to establish some type of habits. And I don't know what X equals for everybody. You have to do that and develop it yourself. But these are just different ways of thinking about money that would get you started to say, okay, if I do this, then I have this much. Can I save that much? And then can I risk that much? So how hard was it for you to do it? It might be so hard that, you know, it's like, damn, that $500 was hard to save. I don't want to lose any of it.
Right.
So now you got to sit down and go, okay, now what do I do? Well, $500, take half of that. You know, you lose $250 or sacrifice it or whatever you want to look at it as. But I always try to relate it back to, what would you have done with it? Well, you'd have saved it until you'd had $500 and gone out and buy some Air Jordans or something. You know?
Yeah. So spend it at the bar on a nice weekend.
Yeah. So it's like, buy a couple rounds for some friends and end of story. So it's like, you still lost it, but you were getting entertained. The other one is like, well, I don't want to lose it because I don't get a chance to entertain my buddies.
Right.
So it's, you know, everybody's got a messed up sense of value anyway. So what you have to do is, you know, sort of stabilize it, work it through for yourself and see how that is. Once you decide you can put $500 in there, utilize it, put that plan down, and you need to have, how much am I going to put forward to this? I don't want to risk all of it on that. Put it into 3 or 4 different stocks or ETFs or whatever, and start to manage that. And it becomes like I said, a risk assessment tool and a way for risk management to start setting in. Then you can go in with bigger numbers. Then you can do different things. Then you won't react emotionally because everything is set up. You know when you're going to get in. You know when you're going to get out. You got different limits on everything. And now it becomes very strategic, and it becomes tactical at some point. And then you just start doing some rotation and watching what's moving and seeing where you want to put the money. Is it into value? Is it into growth? Small caps, mid caps, ETFs, whatever. So hopefully, if anything today, you're able to do a little bit more research into some of these things. Something may have triggered or set you off and say, never thought about it that way. So hopefully you'll be able to derive something of use from today's episode. Again, you can forward any of your questions or any other topics you'd like for us to discuss or address at jcindia@lifestagesadvisory.com. Visit LifeStage's website. We should be increasing our content on there over the next coming months. So we're going to be, revamping with my broker dealer. We're going to be revamping that. JACCPAPFS.com has our tax website. So stay tuned, because the next episode we're going to have here, we're going to be talking about different tax scams, some different issues, delays, what's going on with the filings, and everything like that. So until next time, thanks a lot, and like us, love us, and do what you can to spread the word. WTF.
Yeah, check out the YouTube. We put a lot of time into that.
Yeah, we got some new artwork and post some weekly content over there.
Let us know what you think about that. So anyway,
that's all.
See ya.